To the second panel of the ECB Watchers Conference, which is a panel about stuff ECB watchers didn't look at usually. So we go away from macro. ECB Watchers Conferences used to be about monetary policy, very precisely defined, and it will be going forward also about banking, microstructure, and so forth. Since early November 2014, the ECB is in charge of almost 130 banking institutions, euro area wide. Slightly more than 80% of European banking markets. So European banking policy has been supranationalized, somehow as ambitious as the common currency, which is also Europeanized. And this leads to numerous issues and numerous questions. They might have to do with conflicting goals. They might create tensions. There was at least an old view on those topics, but there's been also an ongoing debate for a long period of time, meanwhile, which actually sees banking politics and monetary policy as mutually supportive. Work by Eric Rosengreen and others in QJE 1999. And we have a very, very distinguished panel to discuss this. I'll start alphabetically, so I'll start with Stephen Cecchetti. Stephen Cecchetti is a professor of economics at Brandeis University. He's known to many monetary economists for numerous reasons. Inter alia, having been the editor of the Journal of Money and Credit and Banking, but in particular because he has always worked in very much an applied environment. He was executive vice president for a number of years of the Federal Reserve Bank of New York, and most recently economic advisor and head of the Department of Money and Economics at the BIS in Basel, where he's been contributing very much to the responses of the central banking community to handling the crisis, because he came into that role with a very good timing in 2008. Then we have Casper de Vries, who is not your typical macroeconomist, because Casper has been working on risk issues for a long period of time. He's been discussing, for example, and I've learned a lot from inter alia, his paper on Basel II, an academic critique, and other papers. So he uses to combine macroeconomic and banking issues, and is also a program director at the Duisenberg School in Amsterdam, and professor of economics at Erasmus, and has been visiting many universities on this globe. And finally, and he will also start off, Governor Liikanen, who is since 2004 governor of Suomen, Panki. Before that, he was EU commissioner for budget, personnel, and administration. He is, how should I say, somehow feared in banking circles because of a report which he has published which has been published in 2013. And he's most impressive because he only starts reading books in case they are thicker than that. So anything below 500 pages doesn't attract any of his attention. So, Erkki, you will start off. Ground rules are 10 minutes, you know, and yours the floor.
Thank you very much, Hans-Helmut. Actually, you gave us three questions. That what are the new responsibilities and decision-making challenges within ECB after all recent changes? What are the challenges of macroprudential policies for the ECB? And what does the new financial regulatory framework architecture do to the monetary policy transmission? I will reply particularly to the first two questions, and we can discuss about the third later. If you look at the new responsibilities, those who are not insiders, it's good to have the big picture. The introduction of banking union has essentially widened the role of ECB in bank supervision and macroprudential policy. ECB was not asking for it. But when banking union was created, according to the court decisions, new tasks can only be transferred to existing institutions. So banking supervision was given to ECB as an existing institution. So in that area, ECB became, in November last year, the ultimate supervisor of the banks in the countries belonging to the banking union. As to macroprudential policy, the ECB cooperates closely with the national authorities and has a right to top up specific national measures, not all, if it considers that national measures are not sufficient. So the Governing Council of ECB is the ultimate decision-making body for monetary policy, micro and macroprudential policy measures. And there are advantages, and of course there are also problems what this brings. The advantage of having the Governing Council as a decision-making body for all three policy areas is that it is able to form a comprehensive view of the evolving systemic risks and taking appropriate actions to reduce those risks. And it can weigh both micro and macroprudential consideration in its policy making. That is to be beneficial for the monetary policy. In addition, assigning the banking supervision to the ECB, it reduces the risk of regulatory capture and excessive leniency of the banking supervision, which we observed in the last crisis. But, of course, there are also problems. There are problems of potential conflicts of interest between monetary and supervisory policy, and they call for organizational separation of monetary policy and microprudential supervision. Therefore, it is very important that the roles of Governing Council and the decision-making body of the banking supervision, which is here the supervisory board, have a clear division. There should not be any overlapping. Of course, for legal reasons, when the Governing Council is the ultimate decision-making body, every issue must be somehow accepted or rejected by Governing Council, but de facto it should be so. The supervisory board or the things supervisory board runs the supervision. I have actually experience from this because Hans-Helmut mentioned about the EU Commission. I was commissioner also for Enterprise Information Society for 5 years, and pharmaceuticals belong to my area. So authorizing of new medicine into Europe was my responsibility, formally, because pharmaceutical agency in London, they couldn't give independent transport, but I never rejected the decision. So I hope that we play the same role with SSM. Supervisors do their job, we accept it, and then there's no long-term problem of conflict of interest. In macroprudential policy, the supervisory body plays only a subordinated role because their focus is microprudential. But of course, connection between macroprudential and monetary policy is close, and for that reason, for macroprudential, it is the Governing Council which is in the key role. And in general, in that area, national macroprudential authorities bear the main responsibility in detecting systemic risks and to take appropriate actions. And so for that reason, national measures, action should be timely, bold and intrusive. But why ECB can play an important role is that it can enhance national macroprudential policies and reduce the likelihood which exists when there is a bias against unpopular timely measures. And I think that we have started to work in that area. I think ECB can play a role. Because if you look at problems from close by, you accept explanations more than when you look at them from further away. What are the challenges of macroprudential policies for the ECB? Of course, We always to be reminded about our mandate. Maintaining price stability will remain the primary objective of the ECB. And as the treaty says, without prejudice to price stability, ECB can support general economic policies such as balanced economic growth. And financial stability is key to realizing this mandate. The SSM, the Single Supervisory Mechanism regulation, assigns macroprudential decision responsibilities to the ECB with power to apply tighter macroprudential requirements than the national authorities propose. That's we jump over the monetary policy area, but then come to the division of work between monetary policy and macroprudential policies. This wonderful table has been in the presentation of Sabin Lautsesleg. I think it's very well done. There's a wide agreement that most of the time and under most conditions, monetary and macroprudential policies reinforce each other. Key policy tools and transmission mechanisms of these two policies are presented in the slide. Monetary policy works mainly through general financial conditions, whereas macroprudential policy works mainly through the balance sheets of lenders and borrowers. When successful monetary policy helps to maintain price stability, the macroprudential policy helps to maintain financial stability. And usually, policies that support price stability will also support financial stability and vice versa. But still, of course, this double role of the ECB as monetary policy maker and the supervisor involves some challenges, and I go through 4 of those. First of all, fundamental challenge facing the monetary and macroprudential policymakers is the different timing and amplitude of business and financial cycles. There are circumstances when achieving price stability may require very expansionary monetary policy, as is today. However, such a policy may add risks to the financial stability by fueling asset prices. And keeping the asset prices and the financial cycle in check requires an ability to take strong macroprudential actions if necessary. Second, as I argued, national authorities have the main responsibility taking the forceful macroprudential actions, but the real problem emerges if the national measures are too timid or come too late. And we have a lot of evidence already from a short period of time about these risks. Let me now have a closer look on 2 other challenges, which are risks of financial dominance and the potential toolkit that the ECB currently has. On the fiscal dominance, it would take hold if the condition of the banking system would become a constraint or dominant on monetary policy. I must say there's no evidence that that had happened. So I think that case is not there, and the ECB will not let it happen. And they have also tools which help us to keep that in control. On insufficient macroprudential tools, there is a problem that some of the tools are not either they are not very efficient, or the use of them is not very flexible. We can come back to that in the details, but for instance, I give you one example only that, for instance, we have a possibility to increase capital requirements, which have, when they are risk-based, have actually small impact on the purpose we are aiming at. Let's say we have a real estate-based bubble. Then we want to increase risk-based capital requirements. These have a big impact on high-risk weight loans and borrowers and minor impact on low-risk weight loans and borrowers. What does it mean? A typical mortgage loan with a risk weight has a risk weight of about 10%, so the increase in loan margin is extremely small. So you actually don't hit this target you have. Instead, the increase in margins for high-risk loans such as SME loans without collateral can be manifold. You try to target the real estate sector and housing, you actually hit SMEs. So there are issues we should work on here. I just finished because Hans-Helmut is showing his time limits, that if you look at the regulatory framework and its impact on the financial system, it can be so that tighter regulatory environment, tighter regulatory rules have contributed to growth in financial intermediation outside the traditional banking sector. And of course, capital market unit is also part of that process. And there's also a possibility that banks focus on activities that consume little capital and restrain from activities which consume a lot of capital. That has been seen in some countries, that they withdraw from SME financing, still are happy to be strong in housing finance. Perhaps I leave this here because my time is out. We can come back to that in discussion. Thank you very much.
Thank you very much, Erkki. That was a very concise and excellent overview of division of labor, of the remit, but also of challenges going forward. So, many thanks for that. Now we will have Steve Cecchetti, whose slide are... I used the next second for a commercial. Steve has one of the best blogs I am aware of on money and finance. Joined with Kermit Schönholz. So great blog. Your slides are up?
Yes, they are. Thank you. Thank you very much, Hans-Helmut, and let me thank Gunter Beck, and let me also thank Ottmar Issing, who is here, and Axel Weber, who started this in 1999. It's an amazing event. I have the same questions, but in the interest of time, I will not read them, except to say that I will try and answer each one of them quickly. But before I do, with apologies to the Wall Street Journal, I want to show you this. We've lost this actually. We're losing this because we don't have the paper version of newspapers anymore. But on March 14th, 2013, the Wall Street Journal juxtaposed this headline that the ECB is to hire hundreds of supervisors next to the new Pope. And I guess the implication, this is an American newspaper. If it was the Financial Times, it would be intentional. So it's probably an accident that they did this. But the idea, I guess, is that we have to appeal to some higher authority if we want to get this to work. So we'll see. Hopefully not. Turning to the assignment, the first question is about how organizational structure affects the ability of an institution to meet its objectives. I believe here the question of whether or not supervision should reside inside of the central bank is settled, and the answer today is yes. Most of us, I think, see substantial benefits derived from central banks having expertise in evaluating conditions in the banking sector, the payment system, capital markets, more generally. During the periods when financial stability is threatened, and this is related to some of the things that Governor Liikanen just said, the central banker cum supervisor will be in a position to make informed decisions about the trade-offs among its goals, knowing whether the provision of liquidity to institutions or markets is going to jeopardize its macroeconomic stabilization objectives. And I think that's essential. And so when faced with threats to financial stability, appropriate action is going to require monetary policy makers and banking supervisors to internalize each other's decisions. And I think that's something that requires also information as well. That the overlap then, I think, is extremely important. It's particularly important in the case of the lender of last resort, where you don't want to be making loans to bankrupt institutions. So I think that one of the most important things is that, like these I don't know how well you can see that. That's supposed to be, so this very striking new building down the river, that's up the river from here, where I was yesterday, is pretty amazing to go inside, but there are these walkways that go between, and the walkways that go between are supposed to signify the cross-checking of the pillars of the monetary policy strategy. And I think in the same way that there has to be information going inside of the building, there is now going to have to be information flowing from between this building and the Euro Tower once it's finished, because the micro supervisors are going to have to be providing information to the macroprudential supervisors and to the monetary policy makers. While the structure of governance of this is complicated, as is always the case in Europe, I think in this case it's not just complicated or unavoidable, but it's also desirable that it be done this way. But as I said, to emphasize, the issue is about information. Now, what about the challenges of macroprudential policy for central banks? We all agree, I think, that monetary policy is the use of balance sheets of central banks to influence current and future interest rates, as well as term and risk spreads. That's what was discussed in the last panel. And I think that is an agreed upon definition. Part of the problem with macroprudential policy is that we don't have an agreed upon definition as to what it is, or a clear objective as to what it is that people are supposed to be aiming at. My own view is that we should think about macroprudential policy as dynamic adjustment of regulations with the objective of sustaining the resilience of the financial system in the face of material changes to financial and economic conditions. Now, people have interpreted the policy toolkit to be quite broad, involving things like capital ratios, risk weights, profit distribution rules, and the like. I'm quite skeptical of our ability to effectively employ time-varying discretionary versions of these if we would overcome what are extremely high information requirements, long and uncertain transmission lags, and significant political resistance. I think that there's still not very much evidence, at least in my view, for the efficacy of these instruments. I've argued elsewhere that as banks have raised capital requirements significantly over the last few years to meet the new Basel III standards, there's been virtually no discernible impact on lending and macroeconomic activity. That is, no impact outside of Europe. And within Europe, what I would say is that this is a consequence of the fact that banks were not well capitalized. This particular picture shows you bank capital ratios in 2006 along the horizontal axis, and the change in bank credit from 2006 to 2013 along the vertical axis. And so that's the 7 years following this. It does include the crisis. It includes a lot of events. But what you see, and I think this is a general phenomena that we would discover, is that well-capitalized banks lend. Banks that are in bad shape don't lend. And so in this regard, and here I would second some of the statements made by President Draghi earlier this morning, the comprehensive assessment has been incredibly important in moving to rectify this problem for Europe. But to expect European banks to lend prior to their recapitalization, I think, was not very realistic. And as a consequence, I think we should also think about the implications of this for the way in which macroprudential policy that's time-varying would work, as opposed to macroprudential policy that simply ensures resilience all the time. And so my own view of the Basel III countercyclical capital buffer then is that the buffer is not likely to work very well, and we should think of through the cycle. Let me skip that and move on to the third. To the third of my comments, which has to do with capital market developments. And why is it then that I think that what we want to think about is why is it that financial markets flourish in New York and London? My answer to this is that it's the legal frameworks, the property rights protections that are created in these places that are not unified across Europe, and that it will take unification of property rights and corporate laws and the like in order to have a thriving capital market. But even more important than that, I would say that we want to consider how it is that finance is going to be supportive of growth. Now, there's been a lot of discussion in Europe about small and medium-sized enterprises, but let me emphasize that small enterprises and new enterprises are different. And it's new enterprises that create vibrant economies and growth. It's entrepreneurship that's important. Not all small enterprises are new, but all new enterprises are small. And so what we need to do is we need to figure out a way in which to encourage growth through firm formation. And just not to put too much fine a point on it, but if you think about a corner bakery that's been run for generations, if you give it a loan, it might be able to do a little bit more business and make a little bit more bread, but it's not going to create a new economy. If, on the other hand, you can find the next Steve Jobs and Steve Wozniak in Steve Jobs' parents' garage, that was a pretty small business in the mid-1970s, and it turned into Apple Computer. So the question then is, how do we do that inside of Europe? The biggest problem, in my view, is that those enterprises are not bank financed, and what we need to think about is venture capital and how to ensure that there's venture capital inside of Europe. So my conclusions then on the three questions, first of all, the ECB's role as a supervisor is an important opportunity, but essential in taking advantage of that opportunity is a free flow of information from the microprudential supervisors who tend to like confidentiality to the macroprudential supervisors and the monetary policy makers. Fortunately, the ECB and the SSM are set up to facilitate that information transfer. Secondly, on macroprudential regulation, I believe that time-varying policies are unlikely to be effective, but we should be thinking instead about ensuring resilience through things like sufficiently high capital requirements, and I would encourage people to consider even higher than we have today. And the third one is that we have to think about creative ways to encourage firm formation and growth in small business in Europe and the creation of capital markets inside of Europe. Thank you very much.
Thank you very much, Steve, for a very concise talk again. You took a papal view of supervision. Never heard of that before.
Thank you very much.
Casper, go ahead.
Okay, thanks. Sorry. I was jumping ahead. I know the time is constrained. Maybe we should put a big clock in the next conference at the end so we can be credible. Anyways, I want to talk not about banks, although this is a conference, I guess, on banking and monetary. And I want to talk about monetary economics and macro and the other sectors. First, talk about the definition of macroprudential policy. Then I want to talk about insurance and pensions, feedback mechanisms in defense. Then I want to make a defense of macro over micro. And finally talk about the monetary relay race that is going on in the world. There are two sort of definitions, broad definitions of macroprudential policy. One is very narrow and only focused on banks and talks about or is worried about the systemic stability. There's a broader objective that macroprudential policy should stabilize the economy and the financial system through the cycle. Well, that's quite a bit. The point about macroprudential policy is that microprudential policy might actually upset the stability of the banking system. And that's why macroprudential policy in the UK, at least, is put above microprudential policy. In Europe, I guess we still have to take that step. In the broader perspective, it's not only banks that we should worry about, it's also about insurers and pension funds. To give you one example, in the Netherlands, our pension funds are so large that we have saved twice our national income. And anything you do as a central bank also has huge effects, actually, on these two other sectors. But with the traditional focus in monetary policy and stability only on banks, you neglect these two other sectors. And I guess in Germany, the same worry has been voiced by the German insurers that are now really under pressure. What are the instruments that we can use in macroprudential policy? This is capital and liquidity requirements that really apply to banks, leverage ratios, technical provisions and the discount rate that really tie in directly with the interest rate policy of the central bank and mainly apply to pension funds and insurers. Margin requirements and loan-to-value requirements, because we also have a shadow banking system, and the shadow banking system is now explicitly a policy of enlarging it, since we want to shrink the banking sector and make it more stable. Then the funding and the credit provision goes to the shadow banking system, and we have to think about what that means in Europe. There are important feedback loops I already hinted about. Quantitative easing depresses interest rates and thereby reduces the funding cost of banks and hopefully increases credit to the economy, but at the same time it increases the liabilities of insurers and pension funds. And the question is, what is the net effect on aggregate demand? Here I plotted the technical provisions of the Dutch pension funds and in green, and the Dutch 10-year yields in red. And you see how these two move completely opposite. And since if the monetary policy and systemic stability at the ECB is just focused on banking system, you may be saving the banks and killing the rest of the financial system. And in my view, actually, at least in the Netherlands, pension funds and insurers are at least as important as the banks. And that is why I want to make the point that we should not neglect the other two sectors as what seems to be happening in the current setup of macroprudential policy. And indeed, so we have this negative feedback loop from interest rates to pension funds that in the Netherlands, because of that reason, had to reduce the benefits that they pay out and had to increase premiums, which directly affect aggregate demand. Same problem for insurers. And so the question is, what is the right balance between the sectors? And that's why I would argue we need an overarching framework for proper evaluation that takes these two other sectors into account. We also have a problem with evaluation. You know, here's the Italian 10-year bond yield and the Dutch 10-year bond yield. And would you know, if you had to compare then the Dutch insurers versus the Italian ones, and during the crisis you would say the Italian insurers are safe and the Dutch ones are at trouble. So my point is also, for any proper interpretation of systemic risk, you always need the macro situation to take into account. You cannot do without, and that's why what the UK has implemented, macro on top of micro, that is the way to go, and not as we are doing now in Europe, putting these two pillars and then have one guy and the top guy sitting on those. My prediction is this is not going to work. So you always need to interpret the situation. Let me turn to the current situation and what QE is doing in Europe and the way we are implementing it. It depresses interest rates, jacks up equity prices, thereby reducing budgetary pressure, and it sits quite uneasily with the Maastricht Treaty. But all empirical research shows that the portfolio balance channel, which QE plays on, is not at all working or effective. The only thing that QE does is actually affect the exchange rate. And then I want to actually what is actually happening in the world is sort of a relay race whereby one central bank after the other starts to buy up government bonds and then basically affects the exchange rate in the old-fashioned way, playing a beggar-thy-neighbor policy. So I think the ECB could have prevented all this talk about problems with the Maastricht Treaty by actually doing what is not spoken about, I guess, in the international fora, but one could have easily achieved the same effect by just doing official intervention without sterilization. It would have been perfectly in line with the Maastricht Treaty. You could have bought up all the bonds that the Fed now wants to shed. You would also prevent this huge distortion in asset prices within the EU, and it would, for that reason, better fit with the macro-proof objective. So let me conclude. We require an overarching macro-prudential policy framework. These should include the concerns for insurers and pension funds and banks at the same and equal level. It's also a necessary condition for capital market union. I think that is really a great thing to strive for in the EU. And therefore, I also propose that we should build an insurance union to level the playing field with banks. And we have boiled this, the banking union in response to the crisis. Now let's take action before we have the next crisis. Although it's going on in insurance, let's build an insurance union as well. And let me finish then with arguing that monetary policy is part of macroprudential policy, but I recognize this is controversial, especially if you recommend to do official intervention instead of buying government bonds of governments that are not willing to act. Thank you.
Thank you very much. Casper, you highlighted the fact that the scope of supervision might be substantially larger, and depending on also the structure of the financial sectors in our rather heterogeneous European economy, so in particular insurers might be affected rather differentially than banks. I would like to give panelists a few minutes to pick a fight.
No, it was actually Mr. Vries who wanted to declare a war, but I don't take that. If you say that open intervention with exchange rates, I mean, he might be working for BIS. Could you explain what it would mean? I don't comment on that. But on the structure of macroprudential, there's been some misunderstanding. Mr. Vries is that it's totally different here than in the UK. It's actually not. I mean, how do we organize this? ECB Governing Council is directly responsible for two areas. It will be monetary policy, primary mandate, price stability, and macroprudential directive. Of course, he has a right to add up complement measures of national authorities. For macroprudential, it's indirect because it's SSM, single advisory mechanism, who runs it, but we have this kind of non-objection principle. But I don't see what's the difference. I think this structure what we have is proper and fundamentally about the same. Of course, nationally, there are different solutions, but all of them go in European level to the ECB Governing Council was right to add up the measures. The other thing, of course, is that we could have more instruments and more flexibility, and we will see what it would bring. I personally think that we still monetary policy must focus on price stability and keep an eye also on macroprudential issues, even though they are not our primary mandate. And we let the macroprudential tools develop. I hope they work well. Third, on insurance, I mean, of course, it's a big area and big issue, but that's not directly in our responsibility.
Thanks. I'll make 2 points. First of all, on the intervention by purchasing U.S. Treasury securities outright by the ECB, I mean, I think that I've been an academic now again for over a year, and I can say that as an academic, this is an amusing thing to consider. It's also, as a textbook prescription, it seems right. Politically, it's war. So you can decide whether to declare war, economic war, by doing that. But it seems to me that that would not be a terribly, I believe I've even written something like this on the blog that you so kindly pointed out. This is an option that you have, but it's not a realistic option. So I think, but of course, it's interesting to listen to governing council members also speak about monetary policy and discuss it with respect to domestic objectives, which I think is exactly the right thing. But it does happen to be the case that the current policy, at least in my view, one of its major impacts is to depreciate the exchange rate, which it has done quite successfully, but not been mentioned really in public comments. One comment about that I didn't make in my original intervention is that I do agree with Professor De Vries that monetary policy is macroprudential policy. I think this is an important thing to keep in mind, is that when you change monetary policy, by and large what you do is you change the slope of the term structure. You change the short, even in normal times, you change the short-term interest rate, but you have a tendency to change the slope. And by doing that, you affect the profitability of banks. And by affecting bank profitability, you affect the stability of the financial system. And so interest rates are, in fact, in my view, a macroprudential tool, and we should think about them that way. But that's all the more reason that you need to ensure coordination between the various prudential authorities and the monetary authority to make sure that they're not working at cross purposes. And I do agree that I believe that the structure that's being set up in the ECB with the governing council and the SSM will create, I'm optimistic, a similar kind of governance than what has been put into effect in the UK. The US is a mess, so we don't want to talk about how that's a complete failure. But it will not work well in the long run, I don't believe. But in any case, I think that we need to ensure this information flow and the consistency of policy, and I think that we're on our way to that. Finally, on macroprudential tools, I guess people hope they're going to work. I'm just not optimistic.
Casper?
Yeah, I'm also not very optimistic that it's going to work. I agree, macro and macroprudential, or macro monetary and macroprudential policy are part of the same house. Well, I mean, if you look at all empirical research, it shows that QE, the only way it works is through the exchange rate. Recalling courses in trade, why not use the direct instrument? Why do it indirectly and provide more distortions? You can say this is politically not done, but in the end, this is the way how it works out. Maybe a slight difference between policymakers and academics. I'm not very optimistic about how the institutional setup in which the microprudential policy is quite separate from the rest in the EU I have a fear that this interaction between the two sides is not going to work as well, and macro is not going to prevail over micro. But we'll see, and I think the UK way, how it is institutionalized, is better. But we'll see how it plays out.
There was a very optimistic view from the north. Too much up north. We do have two lead questions. Elga Bartsch.
Yes, Elga Bartsch, Morgan Stanley. I would like to start out from Steve Cecchetti's comment that we need to take informed decisions on the trade-offs between monetary policy and financial stability. And I would like to probe the panel as to whether you are worried that these trade-offs could actually become more pointed on the back of the ECB's asset purchase program. Because I do share Casper de Vries' concerns about what QE does to financial stability. The insurance and the pension funds were mentioned, but I would also say that in the US and in Japan we learned that quantitative easing causes net interest rate margins in the banking system to compress for years and years. And so this could make life potentially more difficult in the wake of this big step in unconventional monetary policy. And obviously, as the central bank, the ECB, is on the hook as the lender of last resort, not just for the banks, but implicitly now also for governments. Because through buying government bonds, I think it sort of inches towards becoming a lender of last resort for governments. I do think that that is quite important because I think it is the recourse to the lender of last resort that makes government bonds different from other credit instruments, and that's why they trade so nicely that they allow governments to borrow cheaply at the bottom of the cycle and thus stabilize the economy and the financial system. If you lose that ability, then obviously you have a major systemic crisis at hand, like we had here in the euro area not so long ago. And on the back of that, I sort of want to challenge Erkki Liikanen's assessment that so far financial dominance has not been a constraint on monetary policy. When we had a credit crunch, I would say that we already had a constraint on monetary policy where the ECB was pushing on a string and it didn't transmit through to the banking system and easier lending conditions. So in a nutshell, the question really is, yes, we have a new regulatory or financial architecture in Europe, but it's just high time because the trade-offs could become a lot more pointed in the coming years on the back of the monetary policy decisions.
The next question will be Luigi Buttiglione.
Yes, thank you. Luigi Buttiglione from Brevan Howard Investment Product. And I would like to thank the panelists for the presentation today. Usually I have to say when I hear people talking about regulation and macroprudential policy, I suffer, I have to say, and today I didn't, and I'm really thankful for that, and it was really enjoyable. And after this consideration, I would like to link maybe the presentation of this session to one of the points, to the many points made in the previous section. It is heterogeneity. I mean, there was a discussion about heterogeneity, yes, how much, if it is structural, it is cyclical. I wonder, and from that standpoint, it is mainly a question to Governor Liikanen, but of course it's also for the other panelists. If he sees macroprudential policies as an instrument to address heterogeneity. So, there's also always a talk in the past about the problem in the Eurozone to have one instrument which doesn't fit anyone rather than fit all. And this instrument is the interest rate, and then, of course, macroprudential regulation can be seen as an instrument to address other things like financial stability, but maybe part of that heterogeneity in economic performance, if not structure, may be addressed. And this is really a pure question with this kind of tool. And if so, I don't know, it could be tightening conditions in Germany and loosening them in other places. And if so, although I take really on board the objection of Professor Cecchetti on this time varying use of these measures, but I'd like to know really what is your opinion on that, and if so, how you think it would work in the coordination that you so precisely highlighted between the Governing Council on one hand and the Supervisory Board on the other hand. Who would take the initiative? How would these things work if you think it could work? Thank you.
So, could you briefly respond?
always briefly. There are so many comments before you already. Can I make
Erkki,
one?
come on.
I can get to speak one comment only about this.
Venture
capital.
capital. No. You're famous for being concerned.
Yeah, but I say about venture capital, I mean, I fully agree with you that there's difference between new enterprises and small and medium-sized enterprises. Critically, is venture capital market, early stage financing, later stage financing. And this early stage starts to be in better shape than the later stage. There's only in Finland one famous slogan that when you open the door garage in Silicon Valley, you see a venture capitalist. When you open it in Lapland, you see only snow. And that's the difference, which is not always easy to thank. But on the Luigi Buttiglione's question, I mean, you got it exactly right. I think when we have one monetary policy for all euro area, we do it on the basis of analysis of the whole euro area development, money and credit, economic development, money and credit. There are, of course, risks that the natural conditions vary. And macroprudentials are a tool, a possibility in that area. It is at the early stage, but that is a possibility. And I made real comments on some of those tools. But that is that's the child of this recent financial crisis. A lot of effort has been done, started by EBIS, many others are there, and we must give a fair chance and act properly. Have more perhaps tools, more flexibility, but we need that, especially in Europe where we are faced with this divergence in euro area.
I'll make a quick comment about Elga Bars's very interesting questions on the issue of it's certainly the case that quantitative easing is compressing interest margins, but I would say that it's not just quantitative easing that's doing that. I'm sure that regulation's doing it too, and that's an intended consequence of regulation. One of the intended consequences of regulation is to reduce the profitability of banking. And to reduce the profitability of banking, reduce the compensation of bankers, at the same time that competition retains the lending rates and affects lending rates. And I think that this is something that if I could have guessed that this was going to happen, I would have been, that would have been great. I did not believe that this would happen, but I think that in retrospect we're quite pleased. So I don't see that as a problem. I see that as a feature of the current system, one where we know that banks have grown too large and finance has grown too large. The second point that you made about the ECB becoming a lender of last resort to governments, I'm always confused by this because it is a general operational framework of central banks in most of the rest of the world to engage in the outright purchases of their government's debt in large quantities. Okay, and I mean that before the crisis as well as during the crisis and today. And so it seems to me that you take safeguards in the way in which you do it. You don't finance your government directly. We have seen a lot of direct government finance in the past. I don't see the ECB doing that. Finally, I just make one comment about monetary policy in Europe. I continue to believe that there are two issues associated with increases in lending in Europe. The first one is the health of the banks, which was very poor, and the second one was the health of the borrowers, which wasn't so great either. And so, as one of my friends said years ago, you don't deleverage by borrowing. So the idea that people with high leverage in the corporate in the household sector should solve the problem of being over-indebted by going to their banks and borrowing more always seemed to me rather strange. And the idea that you were going to pull yourself out of a stagnant economic environment by encouraging lending to people who had already borrowed too much also seemed rather strange.
Casper?
Well, as an academic, I'm very happy with the heterogeneity and the many instruments because we should go out there and model the trade-offs, and maybe in 5 years' time we have an answer how to really operate macroprudential policy.
So now we would like to open to the audience, to the floor. Some of us confess that it hasn't been boring. He didn't suffer, which we were probably assuming to do. So, yes, please.
I'm Erkki from UniCredit. To Professor de Vries, I was curious about your concern about Dutch pension funds and insurance companies. The role of monetary policy, whether it's traditional or unorthodox, is to discourage saving and encourage investment and consumption, I guess. And one of the problems in Europe, I think, is that a very big part of the savings is locked up in Dutch pension funds and other institutions, which either for explicit or implicit regulatory rules have very tight restrictions on what you can put your money into. And the result of that, to put it over very bluntly, if Dutch pension funds are in trouble because they can only invest in AAA-rated sovereign debt, well, then we have a problem, right? So if the regulatory regime changed and your pension funds were allowed to buy Spanish credits or others with the correct and proper risk management tools in place, of course, part of the problems would be resolved.
Hermann?
Hermann Remsberger, Foundation for Monetary and Financial Stability. I would like to put a question to Stephen Cecchetti. When I listen to Governor Draghi, I got the impression that macroprudential policy should work as a monetary mollifier. If there's too much easing in monetary policy, macroprudential policy should reduce risks for financial stability. But now, listening to your arguments, Stephen, I have some doubts because you have criticized the time-varying instruments in macroprudential policy. So is that all an illusion about macroprudential policy? Is it only a monetary mollifier when monetary policy is too much on the easing side? Just use macroprudential instruments for tightening. Isn't that very far-reaching?
David Marsh.
David Marsh from Omfif. I was struck by this interchange about whether or not the ECB should buy treasuries, because you said, Steve, that this means war. But in fact, that is exactly the policy that's being put around by the esteemed former chairman of the Federal Reserve, whose name begins with B. I can't remember the rest of the name, but he's been going around saying this to people at all sorts of briefings, that indeed the ECB should do, as Casper said, and simply buy treasury bonds. So if this is war, it seems as though a very important former policymaker in the United States means war. So I think we should be told who is serious here.
So,
Hello?
first round of responses. Casper?
Shall I take the first one on the Dutch pension funds and insurers, actually? So insurance are even more constrained than the Dutch pension funds. So this is really where micro bites macro, and why you need to put macro on top and above microprudential policy. Because of these rules, exactly at the wrong time, Dutch pension funds are, and that's why you saw the widening also of the spread between the Italian and the Dutch and German bonds, because the only thing that Dutch pension funds and insurers can buy to hedge against the interest rate risk is exactly German, Finnish, and Dutch bonds, and that's it, period. So indeed, we should think about the macro cycle and the financial cycle, and should understand why this is happening, and why actually at such a point in time you should loosen the rules for where you can invest, and at least allow them to invest more in bonds of the private sector. So I totally agree, and this is why these things go awry, and that's why we need a truly macroprudential framework to discipline macroprudential supervision.
Steve, Hermann?
Yeah, I'll try to respond to Hermann's very important question. I think that first of all, I think that I take it that banks are really smart and really good at their business. And what that means in my way of thinking is that they're optimizing their their behavior by ensuring that they've equated the marginal costs of their different liabilities, equity in the various bonds, etc., and the marginal benefits of all of their assets, given the rules that are in place. If you then change the rules very slightly, there's like a theorem that tells you that their optimization is going to be second order off. So these are second order effects, given that they're optimizing to begin with. That's my view of macroprudential regulation. Now, what is also my view is that what macroprudential regulation is really about is establishing high levels of resilience that arise as a consequence of moral hazard problems that come from people relying on government guarantees and externalities that arise primarily from things like fire sales that I think have been mentioned before. Now, then what's the interaction between this and monetary policy? Well, in my own view is that in a time-varying way, not much. And so long as you set the bar high enough in terms of your steady-state capital through the cycle, or now we have the TLAC rules and all this other stuff that people are going to have, that level of resilience, that then we're going to be fine. The small adjustments that have to be made because of financial stability issues that might arise because monetary policy is encouraging banks to take on risk, encouraging them, by the way, to take on risk which is intended by the policy, right? That's what you're trying to do. I think that becomes a second-order problem.
I thought the idea was to discuss about European financial regulatory architecture when it's more about QE and monetary policy. For that reason, I may need to make a comment on that, only that, our rates are close to zero. We have needed to give more monetary stimulus, and the only way is then to go to large-scale asset purchase. And they work through different channels, as you have seen it already. The rates for longer term are going down. There's some will be portfolio rebalancing. There's a lot of research about that too. And I'm sure what's most important, it works through expectation channel because we have very strong commitment where we link the large-scale asset purchase to forward guidance. So we will do these purchases until the end of September or beyond if needed to achieve sustainable path of close to 2%. That's the way it works. We do it for euro area domestic reasons. There are side effects. One can be exchange rates, but the main effects we are targeting are these domestic ones. I just want to make it crystal clear, and I think ECB has been very correct and proper doing monetary policy for domestic circumstances. On the issue of the monetary policy vis-à-vis macroprudential, of course, there also ECB has one asset. That's the strategy. You have two-pillar strategy. We follow money and credit. And these are, of course, critical factors, aggregates for any macroprudential issues. But still, we should not throw out of the room the question about macroprudential without testing it. There are some experiences in the past which have also worked. But we need to be there careful. I'm more worried about the situation that we have too few instruments and too timid national authorities to use those, than the ability for us, further away, to look at national specific issues. We have had some internal meetings with the authorities and governing council, and it's quite a, let's say, good atmosphere in the sense that both sides accept we need this kind of European approach to different specific macroprudential problems of the various countries. And that is the only way to avoid the excessive timidity which can happen on a national basis.
Casper? Yeah, well, on timidity, of course, it was very funny when the Fed started talking about tapering. Europe was already tapering by 30%. So we seem to be doing actually all the things way too late. And the nice thing of that is actually that you have a lot of evidence, and all the evidence shows that all this talk about portfolio balance sheet, that it has no effect. The only effect is through the exchange rate. Well, then act on it.
My name is Markus Gerber from Berlin Technology University. My question is addressed to Governor Liikanen. who voiced great optimism as far as the regulatory architecture after the creation of the banking union is concerned. I would like him to share the following doubts with me. First doubt is about the bias of ECB. After having 3 bond purchase programs, after having made a catalogue of qualitative easing, and now there's a new dimension of QE, ECB or the national central banks have an immediate impact on the risk side of the balance sheet of banks, and they distort, as has been rightly said by our Dutch friend, competition. How can such an organism, having had that impact and continuing to have that influence on the risk side of balance sheets of banks, be unbiased in the assessment of the risk of banks? Things become even more complicated if you take a close look at the practicing of ELA towards our Greek friends. Factually, ECB and the Governing Council has a veto power. If it goes too far, they might stop the program. And President Draghi mentioned that 38% of GDP of Greece is financed through ECB lending. How can such an organism be unbiased towards the situation of Greek banks? I would be extremely happy if you could enlighten me. I must admit that I'm not unbiased, because I lodged a constitutional complaint against the banking union, which is still pending in our constitutional court, and I'm happy sure we are going to win it. Thank you.
Daniel Groß.
I want to come back to the topic of the session, the financial regulatory architecture, and my question relates to the last remark of Stephen Cecchetti. And I see the question actually more to Liikanen perhaps. I see the potential for a fundamental contradiction between the aims of macroprudential and monetary policy. If we are in a situation, perhaps in which we are right now, when you would like to encourage more demand, but the only people who are willing actually to demand more are those which already have a very high debt level, then we have monetary policy which puts foot on the accelerator, rates down as far as the eye can see, and macroprudential would say, oh, sorry, we don't want to have excessive lending to households which are already indebted. And the Stability Pact, which is the equivalent to the macroprudential for banks, for governments, says, no governments, you can't spend more. So are we in a danger where we are there, have the foot on the accelerator for monetary policy, macroprudential tries to break, and in the end, all we create is a lot of heat, and the economy doesn't really take off?
Yes, please.
Thank you. I wanted to pick up on the question that Luigi asked earlier about using macroprudential as a monetary modifier to compensate for heterogeneity in the Eurozone. That seems to be a very exciting opportunity. The problem, of course, comes back to the difference between macro monetary cycles, business cycles, and the financial cycle. If you were using macroprudential to modify the interest rate essentially on a geographic basis, would you be doing so on the basis of the financial cycle and longer range risks, or on the basis of nearer term business cycle performance and potential for overheating? It seems to me it has to be one or the other. So I'd encourage Governor Liikanen to elaborate a bit on that.
So I would suggest the final question, Philippine Kurtiman. The lady.
Thank you. On the financial regulatory architecture, we have a framework which now favors a lot the holdings of government bonds and not so much of the corporate sector assets, because they are very costly in terms of capital. Now you have a big player, the central bank, which on top of that does a QE, meaning that it buys also the government bonds, favors this holding of government bonds. But at the same time, the ECB wishes to go to price stability and enhance the credit flows to the real economy. There is hope that we get to there, but as has been said by many of you, there are lots of distortionary effects on the way. And there is another tool. We all agree central banks can buy government bonds in textbooks, and historically that's what they do. But in the euro area, that's a more difficult context. And another tool to which Hans-Helmut Kotz is also very familiar is purchasing trade bills, or even refinancing them, or accepting them as collateral, especially because this is also in the collateral framework of the ECB. Like in the regulatory framework, it's favored, so the government bonds are also more favored. The haircuts are much lower than on corporate sector assets. So regarding the trade bills, these are just short-term IOUs, which are very liquid between firms and directly related to real transactions when a firm buys from one another. And I think it's worth continuing to think that this tool, which was historically used by many central banks and by the Bundesbank, by the Banque de France and many others, even up to 1998, whether this should not be put again on the table, and then we have a bit less problems of distortions and of trying to correct for those with potentially useful macroprudential tools. Thank you.
So as Charles Goodhart loves to say, time is the ultimate constraint for us mortals. In a book which is below 500 pages. 4 minutes for the three of you.
Just on banking union, I was in Brussels in the 1990s when the internal market program was adopted and implemented, and the missing piece was the banking union. I mean, Kalle Lanu, the others wrote about that at that time. That was the missing piece, and it's been an important step. And I think key issue is that after this crisis, we finally all have understood, or not all, most, have understood that if financial markets are Europe area wide, or it must be so, and when the bank can get license in one country, can operate everywhere. That supervision must operate in the same area, and you must also be able to resolve the banks in the same way. And for that reason, SSM and also recovery resolution framework are critically important steps for in European integration. I must say, to the credit of the policymakers, that European heads of governments acted swiftly and implemented it. I think it's been major achievement. On what data will be analyzed, I think that's a good question. But of course, I replied it will be comprehensive, medium to long term. I have personal history about macro-prudential tools in 1980s when we had, before the financial crisis, I was Minister of Finance. Our credit growth was about 40% a year. And central bank said, we can't do anything. So I said, we can't do anything, but you must do something. So we proposed finally a tax, progressive tax for credit growth. We never needed to impose, they had voluntary agreement, new reserve requirements with access them to growth, but it was too late. Finally, on the issue of the government bonds, of course, before we took the last action, the ECB and Euro system had a very broad preparation where all experts of all national central banks participated in committees to look at the whole variety of assets which were in the market. If we want to go to this scale, which was sufficiently high, still the agreement was found and sovereign bonds were the way to go. But of course, different private papers were on the list. We have been buying covered bonds, we have been buying ABSs. Other papers were also discussed, but that was the final outcome. But your points you made are, of course, totally valid, and we can always assess. But that was the outcome of very deep reflection. Thank you.
I would like to end this panel on a positive Bostonian note, so Casper. No, you'll be last. Steve, you'll be last.
I guess we are both squeezed on time and on risky or government bonds. Well, let me stop there.
Steve, I agree with Daniel. I think there's an issue about the fact that the banks weren't recapitalized a long time ago. I mean, and the balance sheets weren't fixed. I think that the issue, Krishna Guha's point about and this issue about using macroprudential tools to address heterogeneity, and I think what Luigi was talking about at the beginning. I think this is in my view likely to be contrary to the objective of having a pan-European financial system and a pan-European financial market. Now, I guess it's possible, as I thought about it, that you could say impose, the equivalent of a stamp tax on real estate transactions by postal code. But I'm not sure how popular that's going to be. I think that's going to be pretty much impossible. And so if you have a pan-European financial system, what you're going to have instead is you're going to have the dissociation of the physical location of the borrower and the collateral with the location of the funding. And that seems like a good thing to me, but it is going to create the sort of problems that people are describing. I just have one, it's obviously interesting to think about the real bills doctrine, but unless the central bank is actually planning on buying this stuff, which I think was not the way it was done in the past. It was done as a discount operation. Then you're going to go back to where the ECB was on Friday of last week, which is to having a demand-determined balance sheet rather than a supply-determined balance sheet, and you can't do quantitative easing in that way. The collateral framework of the ECB has something like 35,000 securities on it already. I understand some of them include, top footballers' contracts. That's amusing, but it doesn't seem to work that well. So I think that the purchases in the QE is exactly today the way to go.
Thank you very much. There was at least on my book, a session with lots of food for thought, and I would like to invite you to give a warm applause to panelists. And